Hello everyone, this is Ryan Mallory for SharePlanner.com. Today is September 18th, 2014, doing another live broadcast with you guys via Google's Hangout. And just a reminder, after this is all done, I will have it posted on the website in case you missed something or you can't stay for the whole thing. I'll have it posted on YouTube so you can go back and watch it as many times as you possibly want. So. Lots of great things going on in our chat room today. We got people booking gains of 500% in buying. These aren't even calls that I'm making. I don't even trade options, but there's such like a plethora of different trading strategies from different people of different backgrounds that bring all sorts of great ideas and trades to the table. You got it in Netflix and you got it in Baidu today, where traders are using some option strategies. And like I said, I don't even use the options. I just trade equities. But it's really cool to be a part of a group and a team of traders from all across the world who have so many different approaches to trading in the market to benefit from. So, as much as I hope they learn from me, I can honestly say that I learn a ton from them as well. And they spot trade setups that I don't spot. And I'm glad to be able to help them also in all the ways that I possibly can. So with that said, let's go ahead and look at the S&P 500 right now. Right as we speak, we're on a 3-day tear, and we haven't really seen a move like this since, I guess you could say, going back to mid-August here. About a month ago is when we really had a significant 3-day push here. Actually, it lasted 4 days back in August, but that was really the last move. Since then, it's just been consolidating, digesting gains, and just really giving limited opportunities to make money off of this market. But overall, this was a much needed and everything else. I was really weary going into the FOMC statement yesterday, because usually what you see is on like the Monday and Tuesday, particularly on the Tuesday. Prior to the FOMC statement, you see a lot of contraction in the price, or consolidation in the price, where it just doesn't want to move that much, and it's actually usually really boring. But on Tuesday, it started having the rumor come out that the Fed was going to be pretty good on the rates for quite a while, and the market just went on a ripping tear. And then I said, you know what? There's probably a good chance that if that FOMC statement that comes out on Wednesday isn't perfectly worded and everything that the investors and traders had hoped for, that the market's going to sell off. So I went into the FOMC statement flat, and it wasn't because I did a fire sale on all my stocks. I just sold them all, going into it, because A, the market just wasn't providing the opportunities, and to the long side, and B, I actually just covered some of my shorts, particularly like MGM. We had rode MGM down all the way to 2203. I know what you're thinking is like, man, the lows on Tuesday was only 22, and that's right. I mean, it dropped, and we just tried to get out as quick as we could when it tested that R3 pivot point on Tuesday, and that was like around that 22 mark, and I was able to get out at 2203, and it's done the subsequent bounce. But MGM is a perfect reason why I don't really try to ride a short as low as I can possibly can. Simply put, shorts are made. Stocks are going to bounce when the heavy selling comes in. Eventually, it's going to bounce, and it's just extremely difficult to make a profit if you're willing to get caught in a short squeeze. So when this thing sold off, we made about 7.3% on the trade, but when it got down to that low 22s, that's when I knew I was getting out, and I wasn't going to risk it anymore. As you can see, 2 days later, we're back at 23.68. So since I got out of that short, it has bounced $1.68. That would have wiped out pretty much all of my profits had not covered on Tuesday. So what I'm trying to say about shorting the market is that you don't try to short the market the same way when you're buying stocks. When you buy stocks, it's okay to raise the stop loss and keep trying to see how high you can go, 20, 30, 40%. Heck, maybe if it's a great stock, you make 100% off of it, okay? You're not going to make 100% off of a short. And as the stock continues to drop, the less percentage gains you can possibly make off of that stock from your initial price, because a 10% move at $10 that takes it down to $9 is much different than a 10% move once you're already at $9 going down another 90 cents, because the dollars aren't as favorable. So as a stock keeps on dropping, it's very, very important to realize that when you start getting into that 5 to 7% range, go ahead and book the gains and just move on to the next position. Good chance that if you do that, you're going to avoid those short squeezes. And I'm telling you time and time again, if you try to hold through a short squeeze, or if you just try to ride down a short for too long, you're going to get burned by the squeeze, and you don't want that happening to you. But let's go ahead and look at the S&P 500 here again, because I got a little bit sidetracked on it. Right now, as you can see, we're testing those all-time intraday highs, which is about 2010, I believe, is what it is, 2010.95. So we've broken through it. We've actually established new highs, new all-time highs today. However, we haven't held it yet. But the closing highs, we're above it. But intraday highs, we're not. So it'd be good just to see us get back above 2010 and maybe close at 2011 or higher today. Do well for getting us out of this trading range. And then for the month, you can see we're really not that high. We haven't traded that much higher. In fact, the trading range has been excruciatingly tight. That is your September trading range right there. Okay, you have a low of 1978 and a high of 2009. So that's like 31 points. So like a 1.5% range. You're not talking about a lot of wiggle room in this particular market. I mean, August you had a big range. Even in July you had a much bigger range, even though it was to the downside, and a lot of that downside happened on the last day. Nonetheless, the candle on July is like twice the size of what we're seeing here in September. September simply just hasn't moved, and you can see that just by looking at the daily chart. This market has not moved at all in September. It started here, and now we're into the 18th, and we've just gone down to here, and we've popped up to there in 3 days. I mean, it's just the trading opportunities are limited, and you gotta recognize that, because if you're trying to get 10% moves out of a stock in a market that's only moving 1% in either direction, you're probably not going to get that 10%. Yeah, there's momentum plays that have special news events, but I'm just talking about strict technical analysis, looking for trading opportunities on the breakout. The stocks just aren't going to move 10% for you. Okay. And I know, like I said, on a case-by-case basis, that can be different, but just using strict technical analysis, that can be very difficult to find those that are willing to do that. So let's look at the NASDAQ here. NASDAQ, you have very similar chart to what the S&P 500 has. It's not making new highs, though. I mean, obviously, it's not going to be making all-time highs, because the all-time highs are about 400 or 500 points off, but just new recent highs, we're not there yet. So the tech is lagging a little bit, but then you look at the Russell, it's lagging even more. Okay, and it's still within this boxed range here. So there's been no direction in the Russell at all this entire year. This is what the Russell has been, no direction at all. And then the Dow Jones. Yeah, this one probably has the most momentum going for it, right? Really good, but it also shows you that the money's in the bigger name stocks. Those are the now, and on top of those, it's also like things like the financials. You're seeing stocks like FDX. Yesterday, definitely a pretty good move out of it. The other chart I want to show you is a T2108. This is the weirdest chart out there. So the T2108, there's nothing magical or secret about it. All it does, don't know what that line is. We'll ignore that. Yeah, let's just ignore that line. It sort of irritates me a little bit, but we'll ignore it. The T28, and it's best to look at it from a not in the log setting on the chart. You want all of the numbers equally spaced out when you're looking at the 2108. But this measures the percentage of stocks trading above the 40-day moving average. Now, this thing is showing you that only almost 42% of stocks are trading above the 40-day moving average. But then you got the Dow trading at new all-time highs. You got the S&P, pretty close to closing at new all-time highs. What gives? Why are stock? And to me, it's something that we saw in July and we've seen for most of September, where stocks under the surface are deteriorating, and then the indices just continue to march higher. So in July, you can see here, look at this huge sell-off. Beginning of July saw 75% of stocks trading above their 40-day moving average. By the time that huge sell-off hit, after the big sell-off hit, it was down to like 25%. That's like 50% of the stocks moving, okay? Now, look at July on the S&P 500. You can see during the month of July, it didn't hardly move at all. In fact, you could say it creeped up a little bit higher, but then you had the huge, sell-off on July 31st. Now you look at September, same kind of price action. We're just going sideways, even tighter range. But then look at the T2108 on September, and it's been selling off just like what we saw. Not to the same degree, but still pretty significant, going from 65 down to, prior to Tuesday's rally, down to 33%. So the indices aren't moving, but the stocks are. The stocks are dropping below key moving averages, and we've gotten a little bit of a bounce in the last 3 days. But that is a scary bearish divergence, in my opinion, and I'm just not a huge fan of that. Now let's see if I can switch to a different screen here. I've never tried to do this during the a live broadcast, so hopefully I don't shoot myself in the foot doing this. Here we go. All right, can you guys share pointer reversal indicator just straight off of the sharepointer.com website. On the daily, you got, I accidentally hit the refresh button. Sorry about that. It will load back up. All right, here you go. You can ignore the poor shadow on the right side there, even though they do look pretty cool. The daily SPRI, you can see it's getting close to bottoming out, and then if you go down to the weekly, you can see you had a false print there as well. So how do I make sense of both of these two things here? And that's the key here. Now, if you look at May, we had a premature reversal that went down a little bit and then popped right back up to new highs, and that was a pretty good rally out of the market that time. We're getting the same thing again, premature reversal. I think it's going to do probably the same thing because we've seen it time and time again happen, where you get the premature reversal before it hits extremes, and then you get another one in the mid-range here, and then it's going to just shoot back up. I think that'll happen. So I still think that the bulls do have a handle on this market, and with the daily SPRI showing signs of getting close to bottoming out, I think there's a good chance that we're going to see the market probably push one last time as high as it can, and then it's probably going to, both of them will probably hit them simultaneously, and we'll have a bearish confirmation. Now, when you get the bearish confirmation, the key becomes, because this is what I've seen a lot over the years, is that bearish confirmations don't necessarily mean that the market's going to have this 2008-like sell-off. What it typically has been has a time for consolidation where the market might drift a little bit lower, but it's more or less digesting gains from the recent run-up. And so whether it's a huge sell-off or just digesting the gains, I don't know, but it's good to realize that we could be seeing after the next push higher that we're currently in right now, that there's going to be some consolidation thereafter. All right. I think that's enough on the indices, quite honestly. I'm about blue in the face talking about them. But let's go ahead and just look at some individual plays. Tesla, we had some traders doing some options in it today. I've gone back and forth with this one. I thought about pulling the trigger on it. Obviously, it would have been a good trade. It came down off of that huge momentum sell-off. It went right down to the trend line and tested it perfectly. Let's go back to the logs. There we go. Tested it perfectly and it just bounced. So I mean, I could have made the argument, all right, just trade off of this trend line. If it breaks below Tuesday's lows of 252, then then get out of it, right? So you got about $13 on a. So I'm like over 4% on the risk side. That's just a little too much for me. I didn't want to take it. Kudos for those who took it, but I'll be honest, that 9% sell-off that I think it was about 9% that it had on Monday, that weirded me out a little bit. I just really didn't want to try to catch a falling knife, even though it was falling straight to the support level. 9% moves just out of the blue like that. I don't like playing with those too much. I went right on the heels of one of those. So we added a new trade today, Google, and it hasn't really done anything for us yet. But we're flat on the trade. The potential is here, though. I mean, there's a ton of lines on this chart, so you can ignore them. But one thing I would pay attention to is this huge long-term trend line. Okay, this goes back to before 2013, so essentially like November of 2012. This thing goes back to, and you can see over time it's consistently bounced off of that trend line, and it bounced again on Monday off of it. Okay, the key is that when we bought it, it was getting right through it at the time. But the key is for it to get through this level of resistance here. And if it does that, there's a good chance we're going to see a good strong push into the 600s, maybe like 615, maybe even 630. But there's a lot of momentum, or a lot of buying power accumulating right here in Google, and there's a good chance that once it can clear that like 590 level, this thing's going to be off to the races. So I really like this trade. Amazon's another one I've been thinking about. Simply, let me see if I can draw the line as good as I did last night. This is kind of what I'm looking at on Amazon. You can see there is a support level in the short term here. It's acted as both support and resistance, but nonetheless, it's bounced off of it a little bit, and it's, in fact, you could probably say that you got somewhat of a head and shoulders pattern, especially if we can get back up to like 350 on this stock. Oh no, it should never transfer back over to the. This is why I don't switch screens in the middle, because then I don't switch back. So hold on here. I made a pretty big screw up here. I'm talking about charts that you guys can't see. So, all right. So Amazon. I'll go back and talk about GOOG real quick, because I think that was the. Oh, I talked about Tesla too. I'll go back and do those two there. So my apologies for that. So on Amazon, you got support here, you got support here, here, and here, and it's trying to bounce right off of there. So I think Amazon has a little bit of a bounce opportunity, and it has a little bit of a inverse head and shoulders here. But you got to use a little bit of an imagination. This is basically your left shoulder, your head, and then you got a right shoulder here. And if it can break, you got another level of resistance here too that it'll need to ultimately break if you decide to get long on it. You got this little descending trend line here that once it breaks through like 340 or so, this thing doesn't have much in the way of resistance thereafter. So it's a pretty interesting trade setup, a little bit off the beaten path, but nonetheless I do like it. Rewind a little bit. You guys heard my commentary on Google, but I just want to point it out to you. This is the trend line that I was talking about on Google, where it goes from November of 2012 and has just consistently bounced off of that trend line level, so that if we can get past 590, I think there's a lot of buying interest that'll be attracted to the stock, and it's going to go well into the 600s. Tesla, we talked about this one. This was the rising trend line. It bounced off of it perfectly, and I just wasn't a huge fan of the stop loss and trying to catch a falling knife on Tesla. So good thing for those who did it. It did bounce right off of support there. So that's all you guys missed by not having the chart. So you can see when you do this thing live and you're a one-man show, sometimes you make stupid mistakes like that. Let's look at EMC. This one's been coiling quite a bit since July. It's not really moved in August, but the case could be made that once it can break above 29.90, and that's not too far away, that it's going to rally some for us. So keep that one in mind. PRU, Prudential, huge breakout today. That was on my list. It basically fired right out of the chute and has never looked back since then. So I mean, 2.5%. That's pretty good. One of the reasons why I sort of steered away from Prudential is that it just doesn't make that big of moves. But obviously today is a different matter. So quite the move that we missed on that one. And then Apple. I was at the gym the other day and I saw Kramer talking about Apple, and he thinks that, as long as it stays above 96, that's great or whatever. I don't subscribe to anything that Kramer says. So I think he'd probably be better if he was just doing it all on his own and he didn't have a TV show. But since he has a TV show, he has to make it entertaining, and entertainments don't always go well together. So Apple, I think where Apple might be ready for the next leg up is once it breaks this little overhead level of resistance. So if it gets back above, let's say if it could get back above 102.60, then we should probably see another pop in that stock. And then a couple of positions that we currently still have open. S&V, it's seeing some good strength today. Financials are strong. Whirlpool, we got in this one, but it hasn't really moved yet for us, so I'm trying to remain patient with that one for sure. But the consolidation on Whirlpool is definitely attractive. This one does tend to make some pretty good solid moves. Right now, though, I'm just trying to get it out of the. I won't wait forever. If it wants to just stay in that consolidation range, I'll sell out, with a profit or a loss for it to eventually break out again. So JPM. These are some more financials. You can see this thing's breaking out. Today, $60.30 it broke out of, so it's got about 1.5. I chose SNV over JPM just because the regional banks, they tended to have a little bit more volatility to them than the big banks like JPM or Bank of America or Goldman Sachs. A lot of times those regional banks really go nuts. So Citigroup. This one also breaking out. This one actually did break out pretty heavy today. 52.86 is probably where the ideal place to get in, so you'd be up about 2%. I wouldn't chase it at this point. It's above the R3 pivot level. You don't want to do that. And also keep an eye on some of these semiconductors. I think there might be a brewing storm in that one to the upside. OVTI, it hasn't broken out yet, and it's actually down on a day where the market is up. Nonetheless, if it breaks out of that consolidation at around 28.10, that thing could be quite the gem to trade. MLNX, Sydney in our chat room brought this one to my attention last night. This one is already starting to break out of the base. It'd be nice if it could break the highs from Friday, July 25th. But nonetheless, I see this as a pretty good trade. The volume's not too great on it. It's got about 250,000 shares today, and it averages about 700 to 800,000. I mean, it's good for an individual trader, but I'm not sure if it's enough for me to want to trade it. So that's going to be it for today. If you guys have any questions, always feel free to email me at ryan@shareplanner.com. Or if you're a member of the SharePlanner Splash Zone, I'm in there to work for you guys. So ask me questions, ask me your opinions about stocks. If you have anything that you want me to tell you about or answer your questions on, always post it, and I'll be sure to answer you. And if you haven't become a member of the SharePlanner Splash Zone yet, do so by going to shareplanner.com/splash zone, and you can sign up for a free 7-day trial and see what it's all about and see why everybody else is signing up for it too. It's a great service. We all of us traders in there, we keep risk as our first priority. We don't want to lose money, and we definitely don't want to have drawdowns. So that's our focus there. And then the profits just take care of themselves. And we manage the risk, and we find the right trade setups, and the profits they take care of themselves when we manage the risk prudently. I guess that's the right word. Yeah. All right. Well, you all take care and God bless.